Good morning, everyone, and thanks for joining us today. My name is Alan Goodman. I'm a partner at Goodman's LLP in Toronto and the head of our technology group here. As with many of our panelists, we all act in the venture capital space, and a lot of us work through the life cycle from early stage financing right through to IPO and everything in between. The current COVID crisis has impacted venture capital markets around the world in various ways, and today's panel, we're going to explore the impact the crisis has had both positively and negatively with a view from around the world, with participants from China, Germany, Israel, and the United States. I'd first like to take a moment to introduce our panelists. Yair Giva is a corporate transactional lawyer and head of Herzog Fox and Neiman's Tech Group. He's ranked among the top M&A and tech lawyers in Israel by IFLR 1000, Chambers, and Legal 500. And advises prominent early stage startups and growth companies in cross-border M&A, private equity, and venture capital investments, as well as general corporate counseling. Next is Luke Zhang, a partner at Zhang Lun Law Firm, which is one of the leading full-service law firms in China and the only law firm in China part of our World Law Group. Mr. Zhang has extensive experience in providing corporate, regulatory, and transactional legal services in the areas of private equity and venture capital investing, M&A, capital markets, with particular expertise in advising on cross-border transactions, which combine both offshore and onshore structures. Mr. Zhang has represented many domestic and foreign PE VC funds for investments in China with a wide range of industries, and he's also acted for Chinese companies for their equity and debt financing activities and IPO deals. Next is Jens Wolf, who heads up the VC group of Taylor Vessing in Germany and one of the co-chairs of our venture capital group. He advises national and foreign companies on all matters relating to M&A, VC, and private equity transactions. In that respect, he focuses on PE funds, VC investors, and tech-driven companies. He's been supporting startups and investors in more than 500 transactions, from angel investing to unicorn funding rounds with a volume of several hundred million euros. Together with his team, they routinely act for clients through the investment life cycle from formation to exit. Also with us from Taylor Vessing is Thomas Call, a specialist lawyer in the field of information technology and a partner in the firm's Frankfurt office. He advises national and international companies on all legal questions relating to IT. He's an expert on information technology and the implementation of the provisions of GDPR, with a focus on automotive and mobility and regulated industries such as healthcare and insurance. In addition, Thomas has extensive experience in advising clients on data breach incidents, cyber attacks, data protection, and supervisory procedures. And last but not least is Matt Stamsky, who advises on VC private equity financing and M&A transactions with Fager Drinker in the United States, transforming both startups and established businesses. Matt represents corporate VC divisions, institutional and individual investors, startups, and mature businesses throughout the life cycle. He helps clients achieve their objectives by providing practical solutions to complex legal and business challenges. Matt's work often involves complex transactions with a heavy IP element. In addition to deal work, Matt routinely advises companies on day-to-day matters such as corporate governance, commercial transactions, employment, and IP strategy, serving as de facto general counsel for many clients. So with that introduction of everyone, I think we'll get started now. And we're going to start off by going around the table and just asking everyone to tell us from a high level what may have been the biggest impact that COVID has had on the state of your VC market to date. And we're going to start in China with Luke.
Thanks, Alan. Hello, everyone. It's very nice to have the opportunity to join this webinar and share my observation of the state of venture capital market in China with all of you. The travel restrictions, market volatility, and the general uncertainty caused by the COVID-19 outbreak have had a significant effect on venture capital market globally, including China. We were seeing that the process for venture capital transactions in China was generally delayed or suspended in the first half of this year. Accordingly, the volume and aggregate deal amounts during that period significantly decreased in China. Venture capital investors are more cautious and diligent in reviewing the business of the potential portfolio companies and spending more time to evaluate the impact of the COVID-19 outbreak on potential portfolio companies. and their valuations. While we also seeing that some potential portfolio companies may be prepared to accept a lower valuation in light of their urgent need for rescue money. In addition, certain government functions were closed or understaffed, hindering the ability to obtain regulatory approvals, which would also delay the process. That's the high-level overview of the impact of the COVID-19 outbreak has had on the state of capital venture market in China. That's all. Thank you.
Thanks, Luke. We'll turn it over to Jens. Give us a view from Germany.
Yes, hello everybody. Greetings from Germany. So yes, initially in March and April this year, we thought that the venture capital market in Europe would drive into the same direction as Luke described. But then it appeared that the biggest impact is that COVID-19 has had no significant influence on the European VC market so far. So the reason maybe is that after the record year of funding in 2019, which we had in Germany, France, and in the UK, there is a lot of money in the market that now finds its way into promising startups. And this is despite COVID-19. So what we see is a very, very strong seed market now, with increasing valuations. So we have, and that's really kind of a wonder. We have increasing valuations in 2020 compared to 2019. So the average size of a seed round is now 5 to 10 million euros, is 6 to 12 million US dollars. And we have a still vibrant market in the Series A financing. And what we also see is a lot of bigger rounds with unicorn valuations and with more than 100 million US dollars of new funding. What we see, however, and it's not quite clear if this has something to do with COVID-19 or not, is that there is a slight shift away from Series B, Series C, and D rounds, and that could really cause a problem in the future if it sums up to a kind of funding gap. And one reason may be what also Luke mentioned, that some investors are more cautious and take more time until they do an investment. And because in Europe, there are no really big players who can do as a lead investor these bigger rounds. And so there are a lot of US investors which we need in the European market, VC market, and maybe they are a bit slower and more cautious. And one other thing, what we really see, and this is a consequence of COVID-19, that a lot of VC and growth investors do not longer flinch away from taking over a majority share in the startups and growth companies. And this maybe has to do with some delay in funding. And this is something what is really new, and what we see especially in the UK and in Germany this year, that a lot of VC players come, and this is really new on the market, take the majority of these startups.
Thank you. Yair, what are we seeing out of an active market in Israel in terms of the impact?
Sure. So thank you, Alan, and a pleasure being here. So I would relate, I think, to what Jens had been saying about the situation in Europe. I think we have seen actually, so April was a terrible month. We were people were sitting on the fence and it was pretty dead. Since then, we have seen actually an explosion in terms of financing. We are at the first half of the year at a 40% increase from last year. We've seen more than 300 VC deals, and that's across stages. All stages of financing are well financed. And I think that's probably, as Jens had mentioned, the effect of the availability of liquidity and money, and the fact that funds have been raising before. I guess we'll speak later about what type of investors we see. I will relate though to one point that Luke had mentioned, which is the governmental issue. Although probably from a different reason, in Israel, the government was too occupied and still is probably with the economic situation. So authorities like the Innovation Authority in Israel, what used to be the Office of Chief Scientist, which is providing liquidity funding for the very early stage R&D projects and companies, they have been very slow on providing further liquidity to those young companies. So that's here, I think we are pretty much like China on the government side. But in terms of funding, we are seeing actually an explosion in deals. It's a record year.
That's great. Matt, what about the view from the US?
Yeah, hi, and thank you, and it's great to be here today. And so I'm Matt Stamsky, a partner in the corporate practice at Faegre Drinker. I think we would echo what a lot of other folks are saying. You know, April and May, I think everyone was battening down the hatches, and it went really quiet really quickly. You know, as funds were tending to existing portfolio companies, and there was a lot of triage or damage control. But as you look at the numbers over the course of the year, I think it's interesting to see that, you know, in the U.S., you know, kind of the number of financings and the dollar volume is really on par with where things were a year ago. So the, you know, Q3, the third quarter 2020 looked a lot like Q3 2019 in terms of volume, deal, you know, number of deals, and the value being invested. I think one thing that we're seeing that's different is, and I think I've heard this from a couple of the other panelists, is that there's been a more of a shift to later stage deals, and there's been a drop in early stage, right? So the number of seed or angel rounds, as we call them, you know, has declined, and you can certainly see the logic in that as investors are, you know, making bets on more known commodities and taking longer to vet and to look at new opportunities. So, you know, I think that's an interesting one to see it play out over the course of the next couple of years. And I guess the other thing that we're seeing, you know, are, and we'll talk more about this later, but, you know, I think as people might suspect, the capital is being, you know, drawn to topical and hot areas. So obviously, like pharma, pharmaceuticals, biotech, anything, you know, related to that has been progressing really well. Telemedicine, fintech, edtech, things that are, you know, consistent with the theme of, you know, in the U.S. with people largely working and going to school at home. So kind of no surprises there, but it is a dramatic shift. So I think that's what we're seeing at a very high level here. Thank you.
Yeah, that's great. I mean, I think, you know, we can concur. The theme that people are focusing on what they have as opposed to looking for new opportunities, I think, is pretty consistent around the world. And that's why you're seeing, I think, a lot of the money coming at a later stage rather than earlier stages. People sort of consolidating what there already is in their portfolios. Luke, we're going to swing back to you. As China was really the first to face the pandemic and has been recovering earlier than other jurisdictions, can you give us any insights as to whether COVID has had any significant impact on deal negotiation, transaction structure, or execution in VC deals since we've seen the recovery come back there?
Sure. Yeah, yes, China is the first geography in the world to face the global pandemic. In order to fight against the pandemic since the late January this year, China imposed strict quarantine measures in severely affected cities, and travel was severely restricted, both of which impact the ability to conduct site visits, on-site due diligence, and in-person negotiation on transaction at that time. That period in China lasted until the end of the first quarter. Unsurprisingly, venture capital deals were not active during that period. We were seeing that although some deals that commenced prior to the outbreak were continuing to progress, most of the investment activities in markets were suspended in China at that time. When the situation stabilized and the travel restriction was gradually loosened in China in the middle of this year, venture capital investment have been back to the normal track in China. Venture capital investment professionals are moving forward with investment activities on a regular basis since the second half of this year. And furthermore, some suspended projects revived quickly throughout the rest of this year to make up for lost time. In addition, we're also seeing that an increasing number of companies are looking for financing needs due to poor cash flows. A statistic information from a third-party institution shows that in the first half of this year, the total number of PVC deals in China decreased by 26%, and the aggregate transaction amount decreased by 14%. However, it seems to us that such decrease might be partly or even fully offset by an increase in the second half of this year. Thank you, Alan.
Great. I think we touched on this a little bit in the earlier remarks, but Yair, do you want to tell us in Israel, are there specific industries or sectors that have become more attractive as a result of the pandemic that you're seeing as we move forward?
Sure, happily. And I think let's pick up from where Matt ended, right? Matt spoke about fintech investments and telemedicine. So these areas are definitely hot. You know, also on the exit side, we just closed the 1-800 contacts deal for KKR. So online retail, telemedicine, extremely hot both for VC and the exit. In Israel specifically, you know that about 25% of all investments into cyber are to Israeli companies, and definitely cyber is exploding given the remote access needs and those risks. So cyber is exploding. And anything related to either work from home or play at home, right? So we've seen yesterday in the news here, the first, I would call decacorn from Israel, almost $10 billion company, Iron Source. And any younger companies that have this projection of potentially providing services in-home, whether it's gaming, online gaming, casual gaming, are extremely hot, and these fields are developing very fast. Other fields that we've seen investments into, we just completed a couple of deals into deep learning and artificial intelligence, automation, and of course, this is very specific to Israel. Now that we have signed the Abraham Accord with the United Arab Emirates, there's now new focus as to areas that are of interest to the Middle East. Specifically, I would say food tech and food security are extremely relevant and becoming more and more interesting. Yeah.
That's great. It is amazing how quickly the market pivots with the need for work at home and all the interesting technology that's going to evolve over the next few years as people rejig the way they work and need that support. I'm going to shift gears and ask Matt, have you seen any change in trends after the outbreak of COVID in relation to transaction documentation in connection with VC deals? Anything we've seen, or is it too early to tell you?
Yeah, thanks, Alan. It's a fascinating question, and I spent a little time in the U.S. and in other jurisdictions. Venture capital documentation is still largely driven by the NVCA documents, the National Venture Capital Association here in the U.S. And, you know, largely the form documents remain, you know, unchanged or not really specifically dealing with it. And what we're seeing is that, you know, venture deals are still really getting done on the same paper. Now, COVID is a topic, right? It's a topic of discussion in everything, in every deal that we do, right? And it crosses all industries, right? Because you know, as part of the diligence process, and Luke has mentioned this, you know, we want to know as investors, you know, how has your business been you know, disrupted, right? If people are working at home, can you still get the job done? You know, in medical device, for example, and other life sciences deals, it's of critical importance because we're seeing it very hard to enrolling in clinical studies, clinical trials, both in the U.S. and Europe, has been, really disrupted. And so, we view these really as diligence items, but, when we look at the deal documents, those tend to be kind of matters of risk allocation. And at least in the transactions that we're seeing, COVID is known, right? And it is, the message we're kind of seeing and espousing is that needs to be baked into into a valuation point, right? And there are very few founders or business owners that are willing to kind of, take that risk, and so, we're not seeing a lot of, risk allocation based on COVID. Now, it's different in the M&A market, right? I mean, that does get negotiated more, and there is more kind of the risk allocation. But I'd love to hear what the other panelists have to say. But in my experience, it's a diligence question, right, and something that maybe it impacts value, right? If you can't enroll patients in a clinical study and the funds are being used to fund that clinical study, right, you have a known issue, right? And so it's working that out among the parties about finding the right balance. But as of today, we're not seeing a lot of deal terms that say, if you're sent home again, this bad thing happens because it is known in the market. But again, I guess I would just close by saying, it's extremely fluid, right? And cases are up in the U.S. again, and we're heading into another season of things, and so we'll see. But I think from where we sit, we're not seeing a huge impact on deal terms, but certainly a heavy emphasis on diligence. But would love to hear what others are seeing as well.
I think that's right. It does drive diligence, and it ultimately speaks to valuation depending on the business. Luke, what are you seeing in China on that same point? What would you respond?
I have some supplementary to Matt's comments. The first thing I think the MAC is about the MAC clause, the material adverse change clause. That clause is becoming a focus to be negotiated. As investors are considering whether the outbreak is a valid ground for triggering the MAC clause. And at the same time, the potential portfolio companies may be concerned that the situation, the outbreak presents investor with the chance to easily invoke the MAC clause to walk away. And the second thing I want to mention is that venture capital investor would intensify their focus on downside protection mechanisms such as valuation adjustment, put option to founders, guarantee from founders, and investment by means of convertible instrument instead of equity, and other means of ensuring strong downside protection. This is the second thing. The third thing that we also noticed that the termination clause are more flexible and provide for longer long-stop date for closing the transaction, or automatic extension if necessary. Regulatory approvals or satisfaction of other closing conditions would be delayed by the outbreak-related disruption. That's it.
Thank you. Yeah, I guess, again, risk allocation, and it's working its way through as given the risk and profile of what's going on. Jens, in Germany, and around everywhere, obviously, portfolio companies have been negatively impacted by what's going on. And are we seeing creative ways that investors are trying to deal with that regarding existing investments or new investments or follow-ons, given the impact the cash flows to a lot of these portfolio companies? Oh, you're just on mute there.
Yeah, sorry. So unfortunately, the creativity of the investors was so to say limited. So most of them we saw just we're stepping on the brake in March, April, and May, and then returning with business as usual in summer. The only really creative thing, if you want to really mention this as creative, was that if the further funding need was bigger, we saw investors changing their traditional investment model and shifting their offer from acquiring a minority stake to taking over the majority of shares. They mostly did it to secure the investment, but also new investors had this approach. In one transaction, which started in February, March, and then was stopped and fully on hold until June or July. Initially, the investor, a big tech investor from the Valley, wanted to take a 30-35% share, and then it appeared that the amount of money the startup based in Germany, technology company, was much bigger than expected due to the delay in financing, but also due to the impact of COVID-19, which was a positive impact because strongly increasing business. And to provide this financing at the similar valuation, it led to acquiring a majority stake in this company. And this is what we saw several times, which is quite new in the market, which really reminds me of more private equity style transactions with loss-making companies. So this is really quite new, and yeah, maybe call this creative.
Interesting. And you need to adapt as things change, and that is interesting. A big topic that everyone's excited about, obviously, is the robust IPO market we're seeing in the US and China in particular. Strong momentum this half of the year, despite the pandemic. Matt, we're going to start with you in the US. I mean, what do you see as the main reason for that, a main driver that companies are marching forward in this environment, and will it have an impact on future VC investing, knowing that the IPO market is still quite healthy at this point for tech?
Yeah, it's it's always fascinating, right? It maybe, as a kind of jaundiced lawyer, it's always a little bit frightening. Is a exuberant IPO market kind of the sign of the end? Because that has been a hallmark of the end before. But I think we attribute capital markets activity to the U.S. keeping interest rates low, right? The stock market's still largely outperforming, and then there is appetite for this. Quite a few of the VC style deals that we've done in the last 60 days have been late stage investments in pre-IPO companies, and those are being driven by financial investors, hedge funds, non-traditional investors in the venture market. And so we've seen a blurring of the lines here, where hedge funds and others that are more active in the public markets kind of getting down and tapping into kind of these late stage private companies. But I think that's the economic environment is driving it, right? And there's an appetite, driven by kind of low interest rates and the stock market pouring well. In the U.S., the other, related trend to this is the use of SPACs. So that's special purpose acquisition companies, and so those are public, companies put together by funds to go out and acquire private targets and effectively take them public that route. So the fund will go out to the market, raise money to do its acquisitions, and then acquire a private company. Again, another trend that's helping to drive a lot of companies coming to the public markets, not through the IPO route, but it has a similar, net effect. So, we would attribute it to appetite, non-traditional players, buying up shares in late-stage startups and kind of forcing them to go public, and just overall kind of an environment where people are being rewarded for those risks. So as long as that continues, the IPO market is going to be open.
And Luke, what about in China? Because it's also been fairly robust.
Yeah, the pandemic has certainly had an impact on the global capital market, but despite the uncertain macro environment and impact of the COVID-19 outbreak, Chinese mainland markets remained active in the first half of this year. The Shanghai Stock Exchange ranked first based on IPO volume and ranked second in terms of funds raised in the global market in the first half of this year. China's registration-based IPO system reform and the launch of China Stock Exchange's Star Market is deemed as the most important reason for that. The Star Market is formally called the Science and Technology Innovation Board, and China first introduced the registration-based IPO system in that market. It has attracted companies involved in sectors such as cloud computing, semiconductors, information technology, and biomedicine. Recently, China has approved to launch another board called the Chi-Next board and plans to replicate the Star Market success in this board and the other markets in China in the future. Under the new listing mechanism, companies seeking an IPO no longer need approval from China Securities Regulatory Commission, CSRC, greatly shortening the waiting period. Instead, the stock exchange will review the applications based on disclosure rules. The market will decide on pricing and timing of new share sales. The reform also includes a series of specific rules in the areas of ongoing disclosure, corporate governance, equity-based incentives, and the reduction of holding stocks. The implementation of such registration-based IPO system reform enabled Chinese capital market to become more efficient and aligned with international practices. And we believe that such reform will bring more opportunities for both of the domestic and the international participants in the Chinese capital market, and accordingly will have significant impact on venture capital investments in China. Venture capital investors will be more focused on high-quality, high-tech companies at their very earliest startup stage, and the overseas listing on U.S. exchange market will no longer be the only option for enterprises that have not been profitable. That's absolutely a good thing for each of high-tech companies, venture capital investors, and the industry of venture capital investments in China.
That's great. Lots of big stories that come out in big dollars and numbers when we see those, so everyone always gets excited about that particular market. Shifting gears again, here in Israel, what type of companies attract VCs to Israel, and what issues have investors faced looking to invest in tech companies as a result of the crisis?
Sure. So I sat yesterday with Chemi Peres, who's the son of Shimon Peres, our late president, and I asked the same question, frankly. And what Chemi told us is that these days, and we see it across the board, people are thinking big. So, in Israel, unlike, let's say, China, Europe, or the US, it was very common for people to sell quickly and in an inexpensive price, as even sub-$100 million exits. You'd have these 2 or 3 founders, 1 or 2 VCs that came in early, and then they would sell and proceed. That's really no longer the appetite people have. And both investors, but also founders, are now looking to create big companies, and that liquidity that is available on the NASDAQ is definitely a fuel to that desire. So I would say that first, think big is now the motto, and that's how people look at deals. VCs are looking for serial entrepreneurs, people that have done it before, and not just fresh out of the army, which was typically the case here. People that have sold companies, that have built big companies. And what we also see is that the young generation of founders are now receiving guidance from serial entrepreneurs that have done it before. So I work with a company called Open Web, which is changing the way discussion is done on the internet. And they're getting guidance from the investors who are the founders of Wix. Wix is probably the largest Israeli company now on NASDAQ. So you are seeing people building bigger companies and are looking to really grow their businesses. In terms of issues, I would highlight two examples that people are facing and how they address them. So one of the most interesting companies out of Israel these days is called Via. Via is changing how mobility is done on shared minibuses, and actually a lot of the traffic in New York is done by Via. They raised actually a significant amount of money, $200 million from a European fund, Italian and German funds, just before the COVID-19 hit. And then you ask yourself how a company like this deals with the COVID situation and people staying at home in New York for quite a few months now. And they've pivoted and they've developed new lines of businesses and products to address this interim situation until Pfizer gets the drug out, right? So that's one thing. Other companies, you know, as we have a lot of cyber and anti-fraud companies in Israel, that have been providing services, let's say, to the tourism industry, travel industry, suddenly out of business in that respect. But you would often see balancing via different channels, okay? So if this company is providing anti-fraud services on credit card transactions, perhaps they lose the travel business, but they gain more e-commerce. So when the VCs are looking into those companies, whether to invest or not, follow on with investments, they look at the way these founders are able to pivot, at least for the interim period, until things get back to normal.
I mean, it has been fascinating watching pivots, you know, companies that didn't even know what PPE stood for before this all came down, and all of a sudden they've got these platforms that they've transitioned from other areas to do that, and other, you know, economic impact of the crisis. So it is interesting to watch that and to see that investors are looking for that opportunity, the ability to pivot. We're going to turn to our IT specialist, Thomas. What role does data protection play in the context of IT transactions? And are there special data protection regulations that have to be observed in the course of the transaction? You know, for example, in diligence, and if so, do they play a major role in the practice of transactions?
Yeah, thank you, Alan. So, I mean, my view, obviously, as an IT lawyer, is a bit of a different view on a tech transaction than most of the other participants. And my answer would be, well, the role of data protection increases steadily, obviously, because once I'm working on a deal, that's basically all I'm doing. But I think since GDPR got into play in May 2018, the awareness just raised tremendously. Why is that? Well, first of all, it's a core topic for all the companies. It's a core topic in risk management. Second of all, we see tremendous risks connected to data protection breaches. I think at least in Europe, we learned in the last 1 or 2 years that what has been put up in the GDPR, those monstrous fines, are not some that everyone's waiting for, but we've seen heavy fines lately. I mean, everyone that was following the news, that there was a big discussion around British Airways these days. ICO tried to fine them for 200 million, which is awful lot. Now they seem to have reduced it tremendously, but still. So we talk large numbers. So what does it mean? It means it's a risk factor. I would assume it's also to a certain extent a cost and pricing factor if you have a target company that has big data protection topics, obviously. And that leads to data protection being a major issue, at least from my experience, also in transaction and Q&As in the due diligence. When I look back a couple of years, 5-6 years, it did not play so much of a role. And I think the major Also when we talk about VC, the major topic here is that small companies tend not to have a very good documentation these days when it comes to data protection, because that's a big challenge. The problem is that GDPR is all about documentation in the end. And so that makes transactional work sometimes a bit hard when it comes to assessing the data protection status of a company. So that may be like the bridge over to VC. When it comes to data protection rules to observe, again, 10 years ago, to be honest, nobody really cared about that topic during a transaction. Nowadays, you always have a data protection lawyer coming up and asking, why would you disclose that information in this early stage of the transaction? And everyone goes, So I think there has been a lot more awareness, at least under GDPR. Usually we would work in a step process. So in an early stage of a transaction, you would rather aim for disclosing rather anonymized or aggregated data. And once the transaction moves on, you move towards more personalized information. And once you are like in a final stage, then you can really disclose personal data. And that is something that at least European data protection authorities value if a company follows those basic rules. Still, I would not say it's like a super critical thing, because it's still something that happens behind closed doors, obviously, but we see that this is something where awareness rises also amongst data protection authorities in Europe.
And I think it really speaks, the more sophisticated the VC, the better they understand that and how important it is, because no one wants to get trapped down the road that they invested in a company that didn't have the proper processes in place to protect themselves.
Yeah.
Big US VC funds are such a big part of global VC investing. And just wondering if the engagement of big US VC funds has decreased anywhere as a result of the pandemic. Jens, have you seen that in Germany or in Europe? Any pullback from the US in terms of looking at opportunities overseas?
Yes, indeed. This is one of the downsides of the COVID-19 impact. In my initial statement, I described this all in bright colors, that the market is still vibrant and stable. But the flip side is that in the bigger rounds from Series B upwards, where European startups need, in most of the cases, the strong US funds, there is a decreasing number of investments. Investments are slower, and some of the more mature startups really suffer from a lack of funding, which leads to a lack of growth. So they can, most of them can survive. So there is no big risk that they go bust, but the business model and their growth rate is much lower than expected, and this may have consequences in the next years. And these companies are envisaged on their way to become new unicorns and be on the world market. This will be much slower with the big US investors stepping down from investing in European tech companies.
Would you say, and we had a question to that effect that I saw was addressed by one of our panelists, but would you say some of that is due to travel restrictions and ability to do due diligence, or is it more just a consolidation by those US funds to look at their investments closer to home?
From what I see is that these US funds are still active, but they're active in the domestic market. So the US domestic market is so big, and it has not really to do with travel restrictions. It's more a shift in the focus, more on the domestic market, and leaving out for a moment, hopefully, the European market.
Thanks. Yair, what are you seeing in Israel on that front?
Well, to a certain extent, I think we are seeing the same impact that Jens had been describing. I mean, it's a smaller market, so, and there are quite a few US firms that are so active here that and they have not stopped. So Insight Ventures, for example, out of New York, is extremely active, been doing really great, and continue to invest. Same for others. Sequoia have stopped working here directly, but their former founders have raised funds from the US and are investing. So I think what's happening here is that still a lot of the funds come from the US naturally, but they are invested through Israeli vehicles, and those are extremely active. So the source of the funds is US, but it is possible that there's less direct involvement of some of the US venture capital funds, given the situation. Hard to tell at this point.
I know we've got just over 10 minutes left. I invite people to send Q&A through the chat, through the Q&A feature at the bottom. In the meantime, we'll keep going, but if we see a question, we'll obviously entertain that before our time is up. Matt, I'm gonna ask you from a US perspective, has the role of strategic investors changed in the market as a result of the pandemic? Are we seeing more or less activity from strategics as opposed to just simple VC investors?
Yeah, so it's a great question, and Alan, I would echo your statement earlier. I think we'd love to hear from the audience if there's ever a question that you always wanted to know but were afraid to ask. This is a good time for that. So when we talk about strategic investors, just to frame that a little bit, we're talking about established businesses, typically public companies. In the U.S. that have active either venture arms or funds in-house, and so they're out there frequently, participating alongside the venture capitalists. They're a really integral part of the ecosystem here in some segments. I would say we see it a lot in medical device, we see it a lot in pharma, we see it a lot in agriculture, and so you have big companies, your General Mills, Boston Scientific, others that are out there either seeding in funding directly or co-investing in startups with the hope that there is, an acquisition or some sort of commercial arrangement, a license down the road if the company's successful. For a lot of strategic investors, it represents kind of R&D that isn't hitting the P&L. So they're an integral part of the ecosystem, particularly in some of these areas where particular like intellectual property expertise or supply chain expertise is needed to help a startup kind of get out there. What we're seeing is similar to what we're seeing from financial investors, so traditional venture capitalists. April and May, things were just completely, really shut down as companies, tended to themselves. But the message we're hearing is that the doors are open and that these strategics are open for business. They're looking for deals, and they're out there and they have appetite for it. Typically, the upper management of these companies loves their venture programs because, for every 10 bets they make, they come up with a huge success. The one thing that we are hearing is that strategics can kind of get a bad rap or a bad reputation among founder groups because founders have this perception that they become beholden to that strategic investor or they are kind of off limits for others. And so strategics that we work with tend to want to be very supportive. And what that might mean is that, they'll kind of reflexively or automatically participate in follow-on rounds. And I think what we're seeing here is that, maybe they're still doing the same number of initial deals, but they're being a little more cautious with follow-on rounds. So it's not quite as automatic maybe as it used to be to, and again, when we talk about follow rounds, we mean the B, the C, the D. They're looking a little harder at each of those, which, I guess is not surprising and not necessarily a bad thing. And then, I guess the one other role that we would say is that, the commercial relationships that come with that are a little tougher to manage. In the era of COVID, you can't quite get people to actually go see the technology. You can't, do things. But I think that, people are starting to learn to work around it, just like all of us are doing here on Zoom. So I think that's what I have on that. Thank you.
Thank you. We do have a question here from the audience. Has anyone seen a greater volume of down rounds as a result of the pandemic? And If so, has there been any change in how those are handled and I guess negotiated? I'll sort of throw that open. Does anyone want to take that one on?
We've seen quite a few of flat rounds. In other words, people rushing to fund the companies back in April and May. Not necessarily down rounds, but we have seen flat rounds where you know, people were concerned of what the future will bring, and hence you know, rush to fund the companies. Not sure if others have experienced differently.
Are you seeing those as sort of convertible bridge debt financing, or is it still equity but at the same last valuation round? How is that going in, that money?
At least in Israel, what we've seen are, you know, for very early stage, we are using the YC safe. Otherwise, typically larger equity rounds and less of those convertible notes.
Another interesting question here for the panel. Anyone want to take this? Any traction of women in the field of investors or entrepreneurs? And if so, is that any way tied to the pandemic, or is it just an evolution that we're seeing? Is anyone seeing that in their jurisdiction? I can certainly speak to that from a Canadian perspective. We've always had a very strong government initiative to support women entrepreneurs through financing, et cetera. There's also been an incredible push by government through the pandemic to try and assist with financing generally. So I think some of those funds and some of those opportunities are getting particular focus now, whether we're getting the volume of transactions on that basis, but there's certainly a focus on it, and whether that ultimately leads to more investing in women companies as a result of the pandemic, we'll see. But certainly, because of the government input and the government focus on that, we do see opportunities. What about anybody else? Are you seeing any movement in that area as a result of what's in the last 6 months or so?
Well,
I would say that in Israel, the next generation of venture capitalists is definitely comprised of women, quite to a large extent, much more than before. And I think we are seeing also entrepreneurs, female entrepreneurs, more and more, and these are great news.
So I can echo this for Germany. So there are much more female entrepreneurs in the startup scene than 3, 4, 5 years ago. Most of them are not really in deep tech, but as we see a strong increase in healthcare startups, in cosmetic startups, and a lot of food startups all around the value chain, which has to do with food. We see much more female founders than years ago.
Thank you. Another great question from the audience: have VC funds themselves faced struggles through the pandemic, with respect to raising capital or liquidity calls from investors? Is anybody seeing that on the fund side?
This is Matt at Faegre. And I would just touch on the prior question a little bit, right? Talking about women entrepreneurs and investors, but also more broadly diversity of all kinds, right? I just think that it's a priority for our clients and for our firm, right? I think from a top-down approach, right? It's being prioritized, right? And then also just what you see happening in the market right now. It's happening just as Jens and Yer said, the next generation is going to look a lot different than maybe what it looks like today. But in terms of fundraising, I think the data is showing in the U.S. that funds are still raising capital at a brisk pace on par with prior levels. So there's kind of not a gap, right, in that that we're seeing. And I've not seen personally any real struggles to meet capital calls. Now, I would suspect, industries that are really hard hit by the pandemic, your retail, travel and leisure, like things like that. That's a different story, right? And it's also not historically the place where there's a lot of activity from the venture capital market. But that's the investments we're seeing pace is still robust.
Yeah, so same here in Europe. So on the fund side, we expect the second record year in 2020 after 2019. And for the fund side and the capital raise, the pandemic works a bit like a catalyst converter and is an accelerator for the whole industry in the shift to a digital business. And as venture capital traditionally is focusing on tech and on digital business, it is a lot of money floating into these funds, and this is the opposite of a decrease. It's even more than before the pandemic.
That's great. I think we're getting to about the end. I'm just going to ask everyone very briefly in 30 seconds as I go around the table to just give us one lesson that the VC market may take away from what's gone on over the last 8 to 10 months. Let's just go around the table. Start with Luke. What would you say has been one lesson learned in the last 8 to 10 months?
Good. Yeah. In light of the experience from the current COVID-19 outbreak, when assessing a potential portfolio company, venture capital investors should intensify their focus on how the company plans to continue business through similar black swan events in the future, as well as how the investment terms should be legislated for such events, and actively engage with the founders and the management in formulating the terms so as to avoid any misunderstanding. From the perspective of portfolio companies, they should understand their ongoing liquidity needs under various scenarios and continue to update their cash flow requirements based on various conservative and aggressive business scenario in order to avoid any operation disruption caused by poor cash flow.
Yair, what about you? What about one lesson learned over the last year?
Sure, I'm gonna mention in 5 seconds 2 lessons. Number one, that you can close deals remotely via Zoom. And the second lesson is that you should wear a mask.
Yes, kudos to that. Matt, you?
Well, I echo that, and I appreciate that. But I think you know, what we're seeing is great companies, great founders, right? They're going to get funded, and they're going to you know, they're going to perform kind of regardless of what's happening in the environment, and that's wholly true whether it's a pandemic or a financial crisis or whatnot. I think the other lesson that I've at least learned from other downturns, because I do think we are in some kind of downturn, is that I would be keeping an eye open on that gap, right? If there are fewer seed and angel deals being done, there are still great companies, you know, being born, right? And it's going to be the folks that are out there taking those risks and taking the time to find those companies that are going to be rewarded in the future, because the innovation isn't stopping just because we're all on Zoom.
It's all about pricing. Jens, give you the last word quickly.
Yeah. So good news is that the VC markets are less susceptible than in the dot-com crisis in 2000, 2001, or in the financial crisis 2008, 2009. So that shows that all markets, not only in the US, but also in Europe, and as we learn in Israel, are more mature and more stable, and the risk of downturns are lower than ever. And that's really good news that this was proven by the pandemic.
Well, I think we're out of time. I think this has been, I hope this has been insightful and helpful to people to kind of get a gauge on what's going on around the world. Obviously unsettling times, but the good news is at least that there has been a robust VC market, continues to grow, continues to be active, and you know, we're all here to help to the extent people have questions going forward as this thing evolves. So Hannah, I'll throw it back to you, and thanks everyone for attending.
All right, thanks everyone. I'd like to thank Alan and our panelists, and of course, everyone for attending today. And please take a few moments to fill out that questionnaire. We do have another day left of the e-conference tomorrow if you are interested in continuing to join, and we will wrap that up this week. Thanks everyone.
Thank you, bye-bye.
Bye.